Moving averages aren't just squiggly lines, they're a trader's crystal ball. Many dive into trading, overwhelmed by chaotic price movements, making gut-based decisions. But what if I told you there's a tool to cut through the noise and make informed decisions? These aren't secret algorithms, they're accessible and powerful. In this video, we'll break down moving averages, from the simple moving average to the exponential moving average and more. You'll learn to make smarter trading decisions, spot entry and exit points, and gain a real market edge. Stick around, and by the end, you'll view charts with newfound confidence. Let's get into it. Let's start with the simple moving average, or SMA. It's one of the most fundamental tools in technical analysis, often referred to as the OG of trend spotting. It's not just simple, it's foundational. The SMA is like the building blocks of a house, providing a sturdy base upon which more complex strategies can be built. Imagine calculating the average temperature over a week. You take the daily temperatures, add them up, and then divide by 7. This gives you a smoothed out view of the week's weather, eliminating daily fluctuations. The SMA does this with stock prices over periods like 20, 50 or 200 days. By averaging out the prices, it smooths the data, making it easier to identify trends. The beauty of the SMA is its ability to smooth out volatile price data, revealing the bigger picture. It filters out the noise, allowing traders to focus on the overall direction of the market. It helps identify trends. If prices are above an upward sloping SMA, it's an uptrend. This indicates that the stock is generally moving higher. Conversely, if prices are below a downward sloping SMA, it's a downtrend. This suggests that the stock is generally moving lower. SMAs also act as dynamic support and resistance levels, offering potential entry or exit points. When the price approaches the SMA, it often bounces off, providing traders with valuable signals. Different SMA periods serve different purposes. The 20-day for short-term trends, 50-day for intermediate trends, and 200-day for long-term trends. Each period gives a different perspective on the market, helping traders to make more informed decisions. However, the SMA has limitations. It's important to be aware of these to avoid potential pitfalls. It lags, reacting slowly to sudden price changes. This lag can be a disadvantage in fast-moving markets where quick decisions are crucial. Additionally, the SMA can give false signals in choppy markets. Prices may whipsaw around the SMA, making it difficult to discern a clear trend. Despite these limitations, the SMA remains a great starting point for trend identification and understanding support and resistance. It provides a straightforward way to analyze market movements. It's simple but effective, especially when you're new to trading. By mastering the SMA, you lay the groundwork for more advanced technical analysis techniques, setting yourself up for long-term success in the market. Now, let's talk about the exponential moving average, or EMA, the SMA's zippier cousin. Unlike the simple moving average, which gives equal weight to all data points in its period, the EMA prioritizes more recent prices. This makes it a more dynamic and responsive indicator. The EMA gives more weight to recent prices, reacting faster to changes. This characteristic makes it particularly useful for traders who need to make quick decisions based on the latest market data. This quick response can be advantageous in fast-moving markets, offering earlier signals. For instance, in a rapidly rising market, the EMA can help you catch the trend earlier than the SMA would. However, this sensitivity also means more false signals in volatile markets. The EMA's quick reaction to price changes can sometimes lead to whipsaws, where the indicator gives a signal to buy or sell, only for the market to reverse direction shortly after. The EMA hugs price action more closely than the SMA, providing a different perspective. This close alignment with price can be both a strength and a weakness, depending on the market conditions. Choosing between an EMA and an SMA depends on your trading strategy and risk tolerance. If you prefer a more reactive indicator and can handle the potential for false signals, the EMA might be the better choice for you. EMAs come in various periods like 9, 12 or 26, each offering a different level of sensitivity. Shorter periods make the EMA more responsive, while longer periods smooth out the noise, often used with other indicators like the MACD. Combining the EMA with other tools can help you filter out false signals and make more informed trading decisions. The EMA addresses the SMA's lag, offering a more timely reflection of market sentiment. This can be particularly useful in fast-moving markets where timing is crucial. Offering a timely reflection of market sentiment. By reacting more quickly to price changes, the EMA can help you stay ahead of the curve. But remember, speed comes at the cost of smoothness. The EMA's quick reactions can make it appear choppier compared to the smoother SMA. Understanding this trade-off is crucial. By knowing the strengths and weaknesses of the EMA, you can better decide when and how to use it in your trading strategy. Now let's dive into the Moving Average Convergence Divergence, or MACD. This powerful tool is a favorite among traders for its ability to provide clear signals in the often chaotic world of trading. The MACD uses two exponential moving averages, or EMAs, to signal potential market momentum changes. These EMAs are typically set to 12 and 26 periods, but can be adjusted based on the trader's preference. It consists of three main components: the MACD line, the signal line, and the histogram. Each of these elements provides unique insights into the market's trend and momentum, helping traders make informed decisions. Crossovers between the MACD line and the signal line are particularly significant. When the MACD line crosses above the signal line, it can indicate a potential buy signal. Conversely, when it crosses below, it may suggest a sell signal. The histogram, which shows the difference between the MACD line and the signal line, provides a visual representation of momentum strength. Taller bars indicate stronger momentum, while shorter bars suggest weakening momentum. Divergence, where the price and the MACD move in opposite directions, can be a powerful signal of potential trend reversals. For instance, if the price is making higher highs while the MACD is making lower highs, it could indicate a weakening trend. The MACD is popular for its combination of trend and momentum analysis, making it a versatile tool in a trader's arsenal. It can be used across various time frames in markets, from stocks to forex to cryptocurrencies. However, it's important to note that the MACD is a lagging indicator, meaning it is based on past price data. This can sometimes result in false signals, especially in sideways or choppy markets where clear trends are not present. Customizing MACD settings can help tailor it to different trading styles and strategies. For example, shorter EMAs might be more suitable for day trading, while longer EMAs could be better for swing trading. Understanding its components and how they interact is key to effectively using the MACD. Introducing the Weighted Moving Average, or WMA, which assigns specific weights to recent prices. Unlike the EMA's exponential weighting, the WMA uses a linear approach, offering a different perspective. The WMA is more responsive than the SMA, but behaves differently from the EMA. It allows for fine-tuning emphasis on recent data, making it customizable. The WMA is less common, but offers a unique angle on prioritizing recent data. It can identify trends and act as dynamic support or resistance, but is more sensitive to price changes. The WMA provides a middle ground, offering another tool for interpreting market behavior. Now, let's explore the Cumulative Moving Average, or CMA, which considers all data points from the start. The CMA provides a long-term perspective, unlike other moving averages with fixed windows. It includes every data point, making it incredibly smooth and slow to react. The CMA is unsuitable for short-term trading signals, but useful for long-term analysis. It offers a historical mean, tracking performance over an entire lifespan. The CMA is less about predicting short-term moves and more about understanding long-term trends. It highlights the impact of including all historical data, offering a stable benchmark. While not commonly used for day-to-day analysis, the CMA provides valuable perspective. You've mastered moving averages. From the SMA to the CMA, each offers a unique market view. If you found this helpful, like and subscribe for more insights. Remember, mastering these tools isn't about finding a magic formula, but understanding their strengths and weaknesses. Keep learning, testing, and refining your approach to achieve your financial goals. Thanks for watching, and see you in the next video.